Why do independent creators celebrate swiping a business card for a premium upgrade, fully convinced they are outsmarting the system? The psychological comfort of a legal business deduction makes a luxury asset purchase feel like an absolute financial victory. Yet, why does the exact corporate structure engineered to protect your personal capital frequently leave your cash reserve completely empty? While online financial gurus aggressively hand out automated entity templates, promising a zero liability paradise, a hidden structural friction remains unaddressed. An administrative loop of state franchise obligations, mandatory annual filing metrics, and fixed accounting retainers silently paralyze your actual asset velocity. By overestimating your paper tax shielding strategies, you unlock a systematic pattern that drains operational liquidity before it ever reaches investments. Remaining a straightforward sole proprietor might actually keep your capital velocity significantly higher than rushing into premature corporate complexity. To understand this wealth erosion, we must examine a profound cognitive vulnerability known as the tax deduction distortion. When the human brain believes a transaction occurs through a corporate vehicle, personal spending inhibitions drop to near zero. Consumers willingly deploy an entire out-of-pocket dollar on unneeded upgrades just to secure a 30-cent saving on paper taxes. The empirical math behind the marginal tax benefit versus out-of-pocket outflow metric reveals an undeniable structural asymmetry. Allocating a massive $5,000 for upgraded studio gear to lower a liability threshold creates an immediate formational paradox. While your corporate tax obligations drop by exactly $1,500, your operational capital has sustained a direct, unrecoverable hit. Your small business corporate structure is now forced to absorb a painful $3,500 net cash deficit in real liquidity. This systematic drainage is perfectly illustrated by an economic mechanism we call the corporate leak pipeline. Hard-earned revenue pours into the main valve, but a constant sequence of mandatory state administrative friction immediately begins. Subtle corporate maintenance outlays like recurring registered agent retainers continuously chip away at your foundational business entity capitalization. Before any remaining capital can be transferred into personal investment channels, premium tax preparation overhead completely drains the reservoir. When compliance fees combine with distorted behavior, your net asset velocity slows down to a near-permanent crawl. If you want to unmask the hidden systems that exploit independent creators and upgrade your true financial intelligence, hit subscribe right now to master your asset velocity. Let us analyze a comprehensive 3-year financial track record comparing two highly distinct independent micro-business operators. Solopreneur. A chooses to operate entirely as a sole proprietor, intentionally keeping operational expenses ultra-lean while securing a 75% savings rate. Without an artificial entity buffer, every single dollar of profit retains maximum velocity, compounding immediately within standard personal investment vehicles. Conversely, Solopreneur B rushes into early-stage entity incorporation, immediately onboarding a monthly accountant retainer under the guise of optimization. The resulting data comparison highlights a flawed system where corporate write-off habits systematically erode foundational wealth accumulation. When we isolate the multi-year trajectory, the financial disparity between streamlined operations and premature incorporation becomes astonishingly transparent. Solopreneur. A routinely captures a massive 75% savings rate simply by avoiding the structural drag of unnecessary compliance mechanisms. Meanwhile, Solopreneur B confronts an entirely different reality, as non-negotiable entity maintenance fees consistently erode their foundational capitalization. A mandatory monthly accounting retainer, combined with annual state franchise registration, creates an unyielding baseline deficit before operations even materialize. The pass-through taxation metrics reveal that, despite generating identical top-line revenues, Solopreneur B retains significantly less actual capital. Because the entity structure distorted their spending psychology, Solopreneur B consistently justified unnecessary lifestyle upgrades under the illusion of optimization. The multi-year data proves that paying standard self-employment tax while maintaining lean expenditures yields a vastly superior net worth. The administrative friction of tracking minute corporate deductions frequently costs more in billable hours than the actual tax shield preserves. By the conclusion of year 3, solopreneur A possesses an unmatched financial advantage, unburdened by structural drag or distorted spending habits. To reclaim absolute control over your net asset velocity, you must deploy a systematic behavioral barrier called the Dual Gate Threshold Protocol. This protocol strictly enforces a mandatory 7-day cooling-off period for any micro-business transaction classified under the guise of a write-off. You must isolate the transaction entirely from its paper deduction status, evaluating the acquisition solely on its raw operational utility. If the asset fails to generate direct, measurable cash velocity within your ecosystem, the acquisition is permanently vetoed. Tomorrow morning, look directly at your operational business ledger and run an uncompromising calculation on your current organizational setup. Subtract your exact annual entity maintenance fees and accounting overhead from the actual marginal tax dollars you saved this year. Determine once and for all if your corporate structure is genuinely serving your wealth, or if you are serving the structure. If the net administrative friction outweighs your structural yield, have the courage to dissolve the complexity and return to a lean framework. True financial intelligence means recognizing that a corporate entity is merely a tool, not a psychological license for reckless overspending. By mastering your cognitive vulnerabilities and eliminating structural drag, you secure an unassailable path toward compounding personal wealth. Protecting your baseline capital velocity from behavioral distortion remains the ultimate differentiator in early-stage micro-business survival. When you strip away the mainstream administrative noise, wealth accumulation becomes a simple function of capital retention and velocity. Stop overpaying for a corporate wrapper you do not yet require, and focus entirely on expanding your raw operational margins. Commit to the hard math of corporate optimization, and take complete sovereignty over your economic ecosystem starting today. Upgrade your behavioral economics toolkit, protect your compounding velocity, and join us by subscribing to Economecha right now.